available on our website. And with that, I'll hand it over to Bruce.
Thank you, Suzanne, and welcome everyone in New York, Toronto, and online. We live in unusual times. It has been a year since we did this, and I just characterize it as, whoa, what a year. So, although I guess what I would say is, having been through a number of business contractions, each is different, and each one in the middle always feels the worst. I can tell you that at Brookfield, we have fewer issues than we've ever had before. We have greater liquidity than ever. Our business is stronger and more diverse than at any time. And probably because we started preparing early, the cycle seemed to last longer. And while no company is ever immune, I'd characterize it as we're in excellent shape. We thank all the shareholders of our Brookfield companies for your support and perseverance with us. Rest assured, we are at work in the office every day watching out for your businesses. Most of our securities have traded well, not all, but most importantly, our businesses are strongly intact, and we have vast resources to ensure that each will come out of this recession stronger than what they were before. We also think significant opportunities will be coming in the next 3, 6, 9, 12 months as the recession rolls through the economy. These opportunities will drive our franchise. With those brief opening comments on the day, Nick Goodman and I are going to talk about Brookfield Asset Management first, and I'll move to our presentation. I'm going to start with the conclusion. Our business overall is stronger and more diversified than ever before. Second, a prolonged period of low interest rates is very positive for the overall franchise in many ways, and I'll try to explain that later. We have successfully managed economic disruptions before, and we will this one. The opportunity set in front of us is large, and the opportunity is more scalable than ever before. And lastly, we have record levels of liquidity and have spent decades building up operating expertise to be able to work through these times and excel out the other side. It's important always to remember what we invest in. We own the backbone of the global economy, and I'll talk about why that's important. As a result of that statement, 80 to 90% of our businesses fared well through the economic shutdown. I highlight 4 in the slides. Renewable power was incredibly resilient. Our office building portfolio is 97% leased. Our healthcare facilities were used to take care of the situation at hand, and data centers storage exploded during this period. Despite that, the economic shutdown caused temporary stresses on 10 to 20% of our businesses. Those included short-cycle private equity businesses, hospitality, retail malls, and toll roads. The most important thing today is that those affected businesses are now on their way to recovery, each and every one of them. I'm going to mention 4 overall takeaways from a broad perspective for you. And I think each one of them is important to the franchise going forward. The first is that across almost every capital market in the world, interest rates are close to, if not at, 0. We've been showing this slide for many, many years. And the difference is it said 5%, 4%, 3%, 2%, then it dropped to 0. Even more important, it looks like the forward curve is 0 for quite a while looking forward. And that has various ramifications positively for our business. 2 of them are fundraising for alternatives will be more significant, and real asset values that have long-term streams of cash flow will be worth more in this environment. We've shown you this slide many times. We showed it in close to the year 2000. Alternatives in portfolios of institutional clients were 5%. We estimate that number is 25% today. Through discussions with clients, we estimate that will go to 60%. When we stated that 12 months ago, it was probably on the high end of expectations. Today, it's possibly on the low end, because with 0 rate as an alternative, more money will continue to be pushed into the alternative space. Third, our business model has proven to be resilient through many periods of stress, whatever caused them. This one happened to be a healthcare and shutdown of the economies. In 2008, it was the housing crisis. In 2001, it was explosions around the world. I can go through many others, but the point being, we've built the model to ensure that we can live through these periods of stress, and the last 6 months has proven that out. Fourth, and hopefully most importantly, the business is now launching into the next stage of growth. And I don't want to suggest this is all behind us, but we're now looking to how do we grow the business for the future as we're coming out of this recessionary period. If you look back just for a second, our franchise has grown significantly over the years and very methodically. The business today encompasses $550 billion of total assets under management and has been built up over a 20, 30-year period. While doing so, we've diversified the product offering to ensure that we could deliver products that our clients needed for their portfolios. And through discussions with clients today, it is increasingly more important to them to continue to diversify these offerings for them. While doing so, our flagship funds have continued to grow, which on this slide you can see they were reflecting back circa $10 billion in the second round of fundraising, circa $30 billion in the third round of fundraising, circa $60 billion in this round of fundraising, and what we expect to be a $100 billion round that we've started into. So the business has continued to grow to facilitate our clients being able to invest with us. On top of the flagships, we've continued to grow our perpetual strategies, which are open to our private clients. We started some of those funds in 2015. We've raised $20 billion for those strategies to date. We have a medium-term target of $60 billion, and we think it can be much more significant of that. And these strategies fit the fixed income alternative of portfolios, which is very significantly looking for product today. We've been able to expand those products and diversify the strategies by leveraging the institutional client base that we have. Reflecting back, that was 90 clients in 2010, and it encompasses over 2,000 clients today. We've also increased the number of ways that clients can invest with us, and that includes through private distribution channels in the banks, in RIAs, and in family offices. And also, we've facilitated some investors in the public markets to invest with us in ways that are more attractive to themselves by creating corporations alongside our partnerships. In total, the business has been built through that period of time to, as I said, $550 billion of total assets, $300 billion approximately of that is fee-paying, and we have 1,000 professionals in 30 countries. Nick Goodman is going to talk a lot about our balance sheet and our financial situation, but I'll make just a couple simple points. The balance sheet is very transparent and extremely liquid today. We've strengthened the balance sheet and enhanced the liquidity in very significant ways. We've grown the listed affiliates over the years to be self-sufficient entities. We have high-performing teams within each of the businesses, and all of the leverage within even the affiliates is recourse only, by and large, to assets, and none of it is recourse to Brookfield Asset Management. And it just gives us much more flexibility to run the business as it always has. The liquidity in total is stronger than we've ever had it before, and that includes $16 billion of core liquidity with an increasing amount of cash and financial assets at the parent company level, and over $60 billion of capital that we can draw from clients to be able to invest in opportunities.